There's an old saying that I've seen before around, markets and funds and things like that. And it's basically like most products are for selling, not for investing in. Like they're just products at the end of the product is the right word for it, right? They're being sold to you. They're designed as a product, not so much as a excellent long-term investment vehicle. So yeah, I'm pretty skeptical of most non-vanilla things, let's say.
The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you and, if in doubt, speak to a licensed financial advisor.
Hey guys, welcome to a new episode of Aussie Fire. So today we're going to be actually opening up the mailbag and answering some of your listener questions. So the first one I'm going to be discussing is the idea of selling some shares to invest in solar panels and a battery or a home battery setup. The second one we're going to be talking about is the first home buyer deposit scheme and its impact on the market and whether people should be taking advantage of that or not, depending on the situation. We've also got a question about a couple of different Vanguard ETFs. So as you know, we're fans of ETFs and Vanguard ETFs in general. So we're going to be unpacking a couple of those that we haven't spoken about on the podcast before. And the final question is around timeframes and the idea of investing for growth or high growth specifically when your time frame is 5 to 8 years when you might be buying a property. So we'll unpack whether that makes sense or whether you might need to modify your approach somewhat for that kind of time frame. So looking forward to getting stuck into that. Are you ready, mate?
Absolutely, let's do it.
All right, so the first one we've got here is the idea of selling shares for a home solar setup. So the listener question goes, I'm considering selling some of my ETFs to fund a solar and battery system for my house. What do you think of this idea?
I mean, I think it sounds good. I'm very envious of people with houses. As someone who lives in an apartment, it's kind of annoying not being able to easily install this stuff. I think batteries are getting cheaper quickly. I think rebates are getting better quickly. I think batteries are more likely to be a guaranteed benefit. I think solar's good, but solar's always going to depend on how much you home when you need to spend the energy and then what's the export cost.
Yeah.
But both are good together, of course, but at least batteries, maybe battery and solar, just solar in some cases, I think they're all great investments. I think, people get focused on the ROI aspect, which is fair. It's fair to get concerned about return of investment, but it's like your home. And I think like de-risking your electricity bills, making them more predictable, reducing like the cash flow hits and stuff. I think that's just a huge quality of life improvement for a typical person. So I'm like fairly pro it, assuming that there's not big barriers. That's my high level thoughts at least.
So it sounds like you're almost saying you think it's a good idea even if the numbers aren't that great, just because you think of it in terms of de-risking.
I think it's a good idea if it's a minor loss, neutral or better is how I would describe it.
Minor loss, neutral or better.
Yeah, it shouldn't be something that's like an obvious financial hit.
Yeah, sure. And so, but the thing is then how do you calculate it? Do you calculate it versus not doing anything with that money, or do you calculate it versus like the S&P 500, or how do you then, what's the hurdle rate for whether it makes sense or not?
Yeah, I mean, you have to do it on the investment and the growth for sure. It wouldn't be fair to do it otherwise.
Versus zero or something like that,
Yeah, it kind of depends what you're doing too, it depends all kinds of things. Like, if you're someone out there, for instance, who's going to want to buy an electric car in the next 4 years, you're going to see more and more electric cars being comfortable with like what they call VTL, which is like hooking your car up to your house. Like the cool thing about buying a Tesla or any car really, but like Tesla's the common one people talk about is like there's a 50 kilowatt hour battery in that car, right? And it's like a typical person when they install a battery at home, the most common ones have been 10. So your car's like 5 standard home batteries. So it's like in 5 years, there's going to be a lot more people that actually are charging off their car. And you got to be careful with it. So I think if you're like getting in that territory where you think you'll own EVs or something in 5 years, it might be an investment that's not as critical or something like that. I think it depends on the reason. Like in regional Australia, there's lots of blackouts.
Yeah.
You grew up in regional Australia too, right?
Somewhat regional, yeah.
And it's like when I grew up, we had like blackouts every 2 months all the time. And I realized this, I never lost power in Sydney.
I don't remember a blackout at all, actually, in country Victoria.
Oh, really?
Yeah. Really.
Oh, that's crazy. Yeah, and like northern rivers in New South Wales, like blackouts for like 24 hours sometimes.
Right, okay.
And yeah, I've never had one in Sydney. So it's like for people that live in those regions, it's a very different thing for them. I look at it more in terms of like electricity prices kind of go all over the place. It's just one cost you don't want to deal with. I think what's going to keep happening as they're building solar is electricity is going to keep getting cheaper during the day.
Yeah, when very few people can be using it, obviously,
and where it's
at home,
making
right?
most of its energy.
Yeah, it's generating all of
I have
it.
a guy I know who works in the space, and he said something like, you know, they're going to keep building solar panels until they have enough generating in the fringes of the day, you know, like in 4 to 6 regions, which means during the day, they're just always going to have like quite an excess. That's why have you seen like OVO Energy has like free electricity for 2 hours in the middle of the day?
No, I haven't seen that. Okay.
Yeah, so if you've got like a battery at home, you can just charge the battery up for free.
Yeah, sick. Yeah.
From
yeah.
like 12 to 2 kind of thing. So there's all these kinds of benefits of it that I think aren't just like financial, but are also just psychological.
That's fair. I think one of the interesting aspects is that obviously the savings are also tax-free, which is kind of its own benefit, right?
As opposed to like selling a growth ETF has a tax on it, you mean? Or what do you?
Yeah, well, if you've, almost every investment, you're going to have to pay some tax on that investment, right? So it's going to be tax-free savings. And then the hedge against power prices is interesting because you can expect prices to go up on 3 or 4 or 5% per year, right? On average over, 10 to 15 years. So that you kind of protect against that, or your savings increase over time that way. But then the other part that maybe concerns me with the batteries is the lifespan of the battery, because not only, it makes sense because a lot of people that are getting solar panels, if they live in a home or a house rather, they are not, if they're working outside of the house during the day, they're not able to utilize that self-consumption rate is going to be quite low, where you're not able to consume a lot of the solar power that you're generating from your panels because you might be out of the house and you're not even there to use it. So then you want to use power at night. So then that's when it can make sense if you've got a battery to be storing that power and then use it at night.
I think batteries are super useful for people that are away during the day.
Yeah,
for sure.
Which is probably a lot of people. At least
I think
more
we
than half
talked about this.
households,
That's not you, is it? Right?
No.
Yeah.
So we're at home during the day.
Like you guys can heat up your hot water if you had electricity for that. You can do your washing. You can do all of that dryer during the day.
Yeah.
Yeah.
So we can optimize that side of things. But if you then can't do that, then obviously a battery starts to look more enticing. But then the lifespan of the battery kind of is one that's a bit more grey for me in terms of like being I'm less enthused about that side of things because obviously that's a lot less typically than the set of solar panels that you're getting, right?
Yeah. I think it's really like the cool thing about this topic is it's really circumstantial. And this is where like ChatGPT and AI can be really useful again if you just explain your situation, because the amount of electricity you use, whether you have an EV, when you're at home, all these things lead to different answers in terms of like whether that stuff is good for you.
If you're a massive user, then obviously there's more savings on offer, and if you're like a very minimal user, then there's not as much savings on offer, right? So there's more of a hurdle to you investing large sums of money to then try and get a return on it.
Yeah. But I think the summary for me is it's one of those things where utilities are something you can't escape. So like optimizing for like smart spending and predictable spending in the home, whether it's even buying like a more efficient dryer or like, if your aircon breaks, spending an extra $500 to get like a DC inverter, top one or whatever else, it's like these things can have such a good psychological benefit to your life. Like there's nothing better than knowing that your home isn't just like shitting money all the time.
Yeah. Yeah, efficiency in itself is enjoyable.
Yeah, but you have to weigh it up too. And that's the problem with the batteries and solar panels, because there is a large cost, right? And I have this really old aircon in my apartment. I think it's 20 years old. And I had to look at it. And I reckon it uses about 50% more energy per minute than like
per minute, per
whatever,
yeah. But when you think about it, and you're like per minute, then you're like thinking about churning over.
It probably uses about 40 cents an hour to run. And I was like, I should replace it because something's 50, like a third less electricity. But if I run it for probably like 8 hours a day for 2 months, that's what like $4 a day, 60 days, it's like $240. That's a long time. And I'm going to save a third of that. That's $80 a year or something. It's like I would just never recoup that money until it breaks. And this can be really useful too, is like why it's good to do the math, because sometimes, and people do this all the time with solar panels and batteries, is they do the math and then they're like, oh my God, this is going to cost me 30 grand. It's only going to last 10 years. I'm going to save this much on my electricity and I'm going to save 15 grand on my electricity. That's not really worth it,
Yeah, that's the bit that I think when people are doing these kind of calculations, I think what's often missed is they compare it to, let's say, the stock market.
Yeah.
And they'll say, okay, let's say I get a panel and battery set up, and let's say the whole thing lasts me 20 years, or let's say it lasts 15 to 20 years. So they'll do their numbers and like, okay, I'm going to save X amount over 15 to 20 years. That's comparable to the stock market. So then it's effectively equal. So then let's say it's a great idea because the savings are equal to the return I would get in the stock market. But I would say that's actually incorrect, because after that 15-year period, you then have to replace the battery or the panels or both. So whereas the stock market return will just keep compounding over time. So you have to account for the capex later on to keep replacing, to keep getting those savings. So it's not like a permanent forever saving where you can just keep compounding it.
I think whether you're interested in this or not, this is just my interest in the topic, but used batteries are going to start flooding the market, because the thing is, with an EV, people care a lot about range. Like your car only going 70% as far as it did, it's like a big deal. No one gives a damn about that in their house, really. So we're eventually going to start to see a whole bunch of batteries probably eventually find their way, maybe not into residential, maybe it's a commercial, but there'll be a second life for a lot of these batteries, and that'll probably drive the price down, I imagine, at some point.
Yeah, okay.
Yeah, because like secondhand batteries are cheap, and like, because it's wall space, right? Like you don't care. I mean, because, if batteries are 80% cheaper when they're towards the end of their usable life, you can buy two of them. But you don't care because you just got the space. Stack them on top of each other somewhere, So there's a lot still evolving. And I would say to anyone who's feeling unsure about it, you don't have to do anything about it, because it is still a very turbulent world, with battery, solar.
And the rebates and all that changes all the time. It's different in different states, the state rebates and the federal rebate. So it's going to be different depending on where you live too. Yeah,
and all I'd say to people considering it is that solar panels will not get more efficient. Some people think that. There's like laws of physics that prevent that. They're always like, there'll be a solar panel in 10 years, it'll do 10 times the power or something. It's like, no, that doesn't happen. But they will continue to slowly get cheaper. Some people are waiting for like new battery tech. They're like, I heard on the news that there's a new type of battery coming and it's going to like blow everything away. No, that's not how technology has ever worked. There'll be a new thing, and then it'll be really expensive, and it'll take years to trickle down to the mass economy. So it's like, these are just things that will just slowly get cheaper over time. And, electricity will slowly get more expensive. And if you've got investment somewhere, then, keep investing if you're not sure. All right, the next question is alternative Vanguard ETFs. So the question is that people know that we're interested in ETFs like VGS and VAS, but this listener says, I'm interested in hearing your thoughts on ETFs like VHY and VAP. So Dave, I assume you've had a look at a couple of these ETFs that they're referring to here.
Yeah, I have. I've looked at both of these over the years. In fact, VHY was the first ETF, was actually the first share that I ever owned.
Yeah, okay.
This is back in 2015, actually, so a very long time ago. So essentially, for those who don't know, VHY is basically a Vanguard fund which is designed as a high yield ETF. So it basically takes a look at the Aussie market and designs a portfolio of, usually it's like 50 to 70 companies of what they deem to be stocks that are going to pay a high forecast yield for the next 12 months. Those companies are expected to pay higher than average dividends, higher than the rest of the market. So it designs portfolio. I think the typical yield from that portfolio is maybe like, depends if you include franking credits, but like say 7% versus the VAS, which would be maybe 4 or 5%. So it's a bit higher than the market. And it sounds good in theory, and I was quite attracted to it, especially when I first started investing. I was very dividend focused. But what I found was, in practice, the strategy annoyed me a little bit, because the way they design it is based on forecast yield. And so back in 2015, we were experiencing a mining downturn around about that time. So what happened was the mining companies like BHP and Rio and all of that, they had pretty high dividends at the time. But then I think commodity prices and whatever started collapsing, and it was quite obvious that there was going to be a fairly harsh mining downturn at that time. So what happened was the prices of those companies fell, but the dividends hadn't fallen yet because the earnings and all that hadn't changed.
Yep.
And those things hadn't flowed through. So those companies were trading on very high yields, but it became quite obvious that those dividends weren't going to be sustainable. So what happened was these companies were inside the high yield portfolio VHY because they were trading on high forecast yields, but those yields were like not sustainable because of the mining downturn that was that was happening. So then the companies were held in the portfolio, and then the downturn hit, and then they cut the dividends, and then they were eventually removed from the portfolio. So I didn't like how it kind of played out like that in practice, because it's just like a mechanical layer that looks for high yield.
Just like a random quick question. Why aren't there ETFs out there that invest in all kinds of growth and non-growth stuff and then just sell things and then pay that out as a dividend instead, and then like make it more predictable? Because they're like, oh, well, we didn't get as many dividends this thing, I'll just sell out a little bit of the BHP stock and average it out.
You mean there's LICs that do that, not so much ETFs.
Is the problem with ETFs that they can't, they're not, because they're not active, they just have to trickle
No,
things through?
you have active ETFs.
Okay.
Yeah, you could do that. There is portfolios of ETFs that I've seen designed where usually they'll be strategy focused. Usually they're not like payout focused.
Because wouldn't it be a popular ETF if they said, we're going to give you 4% a quarter?
Well, actually, Vanguard had one like that many years ago. I remember seeing it, and I was like, I'll be interested to see if that takes off, but it didn't take off.
Okay.
So I don't know if it's still around. They might have closed it.
Yeah.
I don't remember the name of it exactly, but they had a fund that was designed exactly the way you're describing.
Yeah, okay. That's interesting.
But most commonly, if people want a very targeted, specific level of payout, usually they'll go for like a listed investment company that tends to pay a more reliable level of dividends, let's say.
Yep.
Just another thing on VHY, because it is more of an active ETF in terms of the stocks in the portfolio change, like I said, based on their forecast yield, you have higher turnover in that. It's not just like a set and forget buy and hold portfolio, because yields change. So that leads to more turnover, which leads to higher distributions in itself, which is, if they're not held for that long, it can be, less tax efficient, obviously. And what it's really doing, I suppose, in its essence, because of the Aussie market, is it's kind of just doubling up on the biggest Aussie dividend payers, which tend to be like the top 50 companies, because we've got like quite a top heavy market, and the top companies all like big and old and like cash producing and pay out lots of dividends. So it just tends to focus on those. The performance over time has been pretty good, but it is a more concentrated bet than like a VAS, for example.
Sure.
As for VAP, that's essentially, it's designed as like a REIT index. It's a Vanguard real estate trust index. So it'll invest in a whole bunch of different property companies, let's say, in the Aussie market. But what I found was a little bit curious is it's designed and labeled as like a REIT index, but REIT is supposed to be like real estate investment trust. So you would think of it as just being real estate investing. So like these companies, like
100 houses, 100,000
yeah.
houses.
They don't really do residential, but you would think that these companies just invest in commercial real estate. So they just buy buildings and they hold them, and then it's a portfolio of buildings, you would think, that are rented out. But it's not really like that, because if you look at the construction of the portfolio, it's actually a lot of property developers, so residential property developers, but they're not really holding onto the stock. They're just like buying and selling. So they're basically a builder.
Yeah.
And other than that, there's like property managers. So they'll be like, they'll develop a property and then they'll sell the property, but then they'll have like the management rights to the company or to the buildings rather. Yeah. So they don't actually own the building. So it's not essentially the real estate exposure that people think it is when they think of owning like a property index. It's not really like...
You're just exposed to the property market in the most general sense of the word.
In different ways, yeah, not by actually like owning the buildings.
Yeah, like it's like I have exposure to a property market, which means I own 2 houses, LJ Hooker,
Yeah, exactly, yeah.
Some construction company.
Yes.
Housing.
Yes. Yeah, no, that's exactly the right way to think about it, I would say.
Yeah.
And also with VAP, it's a very concentrated ETF. So there's only about 30 stocks in the portfolio, and one stock, the biggest stock, which is Goodman Group, which is effectively like a developer and asset manager. They don't really own much, I don't think. That stock is 35% of the fund. So it's not super diversified in terms of the amount of holdings that it has and where the exposure lies, let's say. So that's those ETFs for those people who wanted a breakdown. I don't find them to be super interesting. Out of the two, I don't find the property one interesting whatsoever. Because all those companies are effectively represented in the VAS anyway, and I don't find you're getting that much unique exposure in VAP. And it is a very concentrated exposure to basically just a handful of property developers and asset managers. So I don't find that super enticing. VHY is not too bad as an option, but the way I see it is the Aussie market's already it's pretty income friendly, right? If you want dividends, the Aussie market in itself is pretty good. We've got lots of big dividend payers. So if you want to concentrate on that even more to like the top 50 dividend payers, VHY would be a good choice for that, I guess. But I just find it's easier not to bother and just accept that the Aussie market is, fairly dividend friendly anyway, and just go with that. I don't know if you've looked at either of those or.
Oh, I used to invest in the iShares equivalent. They used to have a high yield
ETF.
Can't remember the IOZ, maybe something like that.
No, that's the regular index.
Okay. Yeah, it's one of them. It's been a while now since I invested in it, but at least I think it was an iShares one. I was definitely in a high yield one for a while. Maybe it was a different one, but I think after a while, I just kind of I had it for a couple of years and I just looked at it and it just wasn't performing how I thought it might. And I was like, the dividends were similar to VAS and it wasn't going up in value as much.
Yeah.
And I was like, nah, that's the end of that experiment for me. But no, I haven't looked at the property one as much. I mean, obviously I've been fairly anti-property generally. I've become dubious of some of these like thematic ETFs as well. Like you see them pop up sometimes. It's like a really recurring theme.
Yeah,
it's like,
I've never liked thematic
We're going to
ETFs.
start like a health ETF and everyone's picturing like, these really nice things. Then it's just like Johnson & Johnson, like something in that.
It becomes like a pharmaceutical ETF. Because it's like somewhat health related or something.
Yeah, I think there's like a trend where the way ETFs are marketed. I mean, you saw this with Spaceship when Spaceship launched and they were like, we're super fund about tech. And then everyone paid it out because it was like they had BHP in it or something.
Yeah, okay.
Something like this. I'm like dubious generally when someone's like really specific ETFs, and I tend to stick to geographies, but yeah.
There's an old saying that I've seen before around, markets and funds and things like that. And it's basically like most products are for selling, not for investing in. Like they're just products at the end of the product is the right word for it, right? They're being sold to you. They're designed as a product, not so much as a excellent long-term investment vehicle. So yeah, I'm pretty skeptical of most non-vanilla things, let's say, because they turn out to be, a lot of the times these fund managers they've got a business to run. So they're just seeing what they think will resonate with people. Quite often it's like flavor of the month type ETFs, whether it's like cybersecurity or whether it's green energy or whether it's AI or something like that, or weed stocks for a while there. That went a bit crazy. So there's always that basically throwing shit at the wall and seeing what sticks, right? Seeing how much money they can attract to basically harvest management fees. I don't care if it works or not. They only care if people invest in it, not how well it performs.
Yeah, I think it's important to remember, like, think about it from the perspective of the business, which is that when they make a new ETF, they're trying to get more of your money. They're not trying to get you to sell and rebuy stuff. I mean, sure, they're not trying to get that, but they're trying to think about how do I motivate this person to spend more money than they already are, right? That's like what all businesses are doing. So therefore, to do that, you got to be a bit different and trendy and say, here's a new thing and get people excited about it for sure.
Well, that's why there's more ETFs than stocks now, which is a crazy little side note. All right, so the next one is around the first home buyer LMI scheme that you might have heard about. So we are approaching this question a little bit late there, Hayden. We did get this a while ago, but it's taken us a while to get through our question. So effectively it goes something like this. I'm curious about the new government scheme where first home buyers don't need to pay LMI. I'd like to get your take on what it means for someone who's investing and how this affects choices now versus 6 months ago and 5 years ago. I'm in my late 20s. Many of my friends have had houses for a while. Some are buying now, and I just invest in shares. Do you think this will push house prices up more in the near future? And hypothetically, should people pivot from shares and jump on this? Interesting choice of words.
Yeah, I mean, if the government, let's make an assumption first and say the original cost of LMI is high enough that, LMI is a funny thing, I think, to me a little bit, because if you can afford a 5% deposit plus LMI, you're usually not too far off a 20% deposit in the grand scheme of
things. I don't know about that.
Oh, I mean, if you manage to save 10% of a giant piece of capital, it's not like something where you're going to have to wait 5-6 years to get the extra money. Most people have someone they can borrow the gap off or something like this or, something like that.
Yeah, maybe. But then there's, by the time you get to 20, the market's moved, so now you need another.
Sorry. My point here is the main thing that it seems to help with is simply just that people can do it sooner, obviously. And, that's going to drive up prices always, right? That's just a fact.
Any sort of saving or help or scheme where there's a grant and all that effectively just feeds into prices because it increases what people can afford because it's a cost they don't have to bear, like the stamp duty thing we were talking about earlier.
You can think of it like you're gonna buy a house or apartment now. You're gonna be able to put less money down to buy it because LMI's skipped, and that apartment's gonna cost finitely more than it was previously because more people can do what you're doing. And we're all just hoping that either the price increase is less than the LMI or that it doesn't matter because even if the price increase was greater than the LMI, at least you've got capital sooner, you know? So yeah, it would increase prices. A jump seems a bit, I mean, I wouldn't call it jump, but it's like, it's definitely going to push them up a little bit. It is a good thing. It probably just means people have more choice and access to things now. Like, I don't really see it as a problem. I think it's a reasonable policy myself, particularly in like a world where you want to reward young, hardworking people. Like if there's a hardworking young person who's able to get a job and pay a mortgage down and they've got 5% and they don't want to spend 10 or 20 grand or whatever the amount is on LMI, like sure, great. The government can support that once in their life. Whether or not someone has to like sell shares to do it, it's really up to you. I don't feel like this scheme, I mean, what I was trying to say at the start was like, I don't think this like dramatically changes a lot. You know, like people out there wasn't like a huge amount of people out there who like had to wait years if they were between 5 and 20%, you know, because they could just pay LMI. So it's like, yeah, it helps a little bit. It's not like going to completely change the outcome of someone's life in the end, but yeah, it's a good thing if you want to get started.
Yeah, I think it's mostly just going to result in an extra, if it saves you 15 grand, now you've got 15 grand that you can pay more for a property, which tends to be, as a society, that's what we've done over time as incomes have gone up and as it's been easier to borrow more money and as wealth in society has increased. We've basically just decided to collectively funnel that into homes, right? And so any sort of extra bit of help or extra cash, we just funnel that into property. So I do think it's definitely already having an effect on home prices, but then there's also like a psychological factor too, because if people think that it's going to increase home prices, then people will get in the market sooner. People will then be interested in buying an investment property, not because of the LMI, but because they think it's going to be a good time to buy a property because they think the LMI scheme is going to push prices up. So once you believe things, then it becomes a real thing. So there's that kind of sentiment play that's happening as well in the background. I definitely think that maybe this listener's having a little bit of FOMO just from the certain words that they use, like, should I jump on this, and comparing themselves almost to their friends. Many of my friends have had houses. I'm just investing in shares. Yeah. I think we've probably talked about that a bit in the past, but you want to make decisions that are right for your own life. You don't just want to do things because of a trend or because of momentum that you think's happening or following what other people are doing. You want to be doing it if it makes sense in the context of your own position and your own goals, right? So if you want to own a home, then this may help you own a home sooner. And so if that is your goal, then you probably do want to get in sooner rather than later. But if you don't really care about owning a home for the next 5 or 10 years, then maybe just keep investing. Don't worry too much about what's going to happen in the next.
Yeah, it shifts the motivation. It doesn't like completely reposition it.
Yeah.
Like it's the same thing for me of like, you know, let's say you're doing some kind of investment property or debt recycling. If your income drops and therefore your tax deductibility drops, you know, it shouldn't fundamentally change your view on stuff, but it's going to shift you a bit in that direction. And for someone who's already previously on the edge, it might shift them over.
Yeah.
So yeah, if you're someone who was like not really interested in property and then this LMI thing comes around, it's unlikely it should just be like, oh my God, now's the time to do it. But if you like really weren't sure if you should buy a home, you just like shares a little more than a property, and you had to pay LMI and it seemed wasteful, and then this comes the same with the stamp duty exemption.
Yeah.
You know, like I wouldn't have bought an apartment without the stamp duty exemption.
That's interesting.
But I was very like, tickling with it.
That's super interesting.
And like that made it happen. So it's a similar kind of thing here. So yeah, if you're not feeling like you're already on the edge, then I wouldn't let things that make small shifts push you.
It's so interesting though, because I don't look at it like that. So
he's paid a lot of stamp duty in his life, so he's over it now.
I have though, but even in the first instance of buying a property, I didn't think of it like, because I would think, right, if you want to buy a property to live in, you're not so much thinking about LMI, you're not so much thinking about stamp duty, although yes, you have to pay for those things.
Stamp duty is day zero risk. That's how I think of it.
But it's such a big fundamental life-altering decision that you want to make it based on the idea of owning the property, not just because of some ancillary costs associated with buying the property.
For sure. But if you're making a decision where you're uncertain if it's the right decision, It's like a day zero irreversible cost is my point. It's like the solicitors, stamp duty, and seller's fees are like your immediate irreversible costs. So, but the way you think about it's right, because you're like, well, if you buy a property and you think 1,000 days in the future or 5,000 days in the future, then the stamp duty is irrelevant.
Because I don't think of it like, well, if I hate it, I can just sell it the next week.
Yeah.
I just that's
you're like, well, I know what's going to happen in the future, and this cost just amortizes into nothing.
Yeah, I can just be like, well, worst case, I can just sell it. I can just turn it into a rental and then sell it in 5 years or 10 years. And even if you don't make lots of money, it doesn't matter. Like, it's not a big problem,
Yeah.
Yeah, so I don't think about it in terms of like that money's gone straight away.
I also can't not think of stamp duty as money I had to earn, because you think about it as the cost of doing business in a sense. You know what I mean?
Yeah, like it's just
it's the cost of replacing the tenant's oven, and like it's just the costs of being involved with capital. Whereas in my head, if the stamp duty is 40 grand, I'm like, well, that was 60 grand of income before tax I had to earn.
Okay.
I hated my life between March and October. So you're telling me I woke up every day and went to that fucking job just to like send it to the New South Wales government because their stupid tax structure for something I'm not sure if it's the right decision. But that's day zero thinking again.
That's super interesting.
Yeah, anyway, sorry.
It's just fascinating how two people can be kind of philosophically aligned but think about things so differently.
We consider all views on stamp duty to be a safe thing in this conversation, whether you're on Dave's end of the spectrum or mine.
Yeah, I would just reiterate and say you want to be buying a property for the right reasons. I would say I wouldn't buy anything based on a short-term offer or a short-term saving, even if it might be, a decent saving, let's say. But I would try and not make short-term decisions or have those things sway my decisions when I want to be thinking, decades in the future. So yeah, I would think about it that way, because it's definitely not something, even though I just said, worst case you can sell it, it's not something that you want to take lightly and just kind of jump onto as our listener has asked us, because we've had multiple people now write into us on the podcast, Hayden, in our inbox that said, I think one of them we featured in a previous episode, where they bought a property and they realized they hated the experience of property ownership, so they sold it. And we've had, and I remember another email that came through that's basically they bought a property and now they're 6 or 9 months in, something like that. And again, they don't enjoy the experience of owning property. It's more expensive than they thought. There's more problems than they thought. Then now they're thinking they basically like regret it and they're thinking of selling it and they're not sure if it's the right decision, whatever. And we might unpack that in a future episode. But it just goes to show you that it's not for everyone. Like, there are things to consider other than just the finances and other than just, a short-term offer or a saving here and there. So you definitely want to think about whether it's right in the big picture of your life and the context of your goals and where you're trying to get to, because it may be, but maybe not.
Yeah, for sure. So our last question for today, the question is 5 to 8 years enough for high growth investing in terms of time frame? The questioner asks, I have two main goals and time frames. The first one is medium term for buying a property, 5 to 8 years. The second one is long-term retirement, 25 plus years, which I will go with VDHG plus IVV. So that's like a super diversified general ETF and like an S&P 500 ETF. For the medium term, is it advisable to have a less risky ETF like VDBA? For those that don't know, that's a conservative Vanguard fund, 50-50 stocks and bonds. So it's kind of like VDHG, but more on the other end of the scale where it's a lot more conservative. Or is 5 to 8 years long enough for a high growth strategy? So basically, there's a person here who is trying to say, I'm going to buy a property in 5 to 8 years. What is the right place to put capital to maximize growth without, having too much turbulence that it's just a bad time to pull it out in 5 to 8 years? And the question is like, should I go down the route of like a Vanguard, conservative, general ETF essentially? That's an interesting question.
It is an interesting question because it's also an interesting time frame that we don't deal with too much. A lot of the time frames that we're dealing with when we get questions like this, Hayden, it's usually like 3 to 5 years. I want to buy a house in 3 to 5 years. And so it's a lot easier to answer because 3 to 5 years is not a super long time to be invested in the stock market because, as we know, things can happen quite rapidly. But when you've got 5 to 8 years, things start to change a bit, and it does make more sense to take more than zero risk it does make sense to then add a bit more growth into that kind of scenario. What I would say is it's again going to depend on how locked in you are to that time frame. If you are locked into that time frame where you definitely can't go past 8 years, then I would say one way to do it would be, I wouldn't save in cash for that whole time. That's just too long, personally. I would probably go something like for the first 4 years, let's say, that's maybe half the time frame, I would invest super aggressively. So maybe like you do a scenario or the portfolio that he plans to invest in later on, which is VDHG or S&P 500, something like that. Go super aggressive for the first 4 years, let's say. And for the last 3 or 4 years, then you can pile up cash in that scenario, and you kind of leave the aggressive side of thing to just kind of hopefully compound, but maybe not. And you kind of reduce your risk by piling up cash in the last few years. So I would probably approach it that way. There is another option where you can invest in, I believe the fund is VDGR, where it's basically Vanguard Growth instead of Vanguard High Growth. It's like VDHG, but slightly less aggressive, where it's 70% invested in stocks and 30% bonds. So that could be more suitable for a medium-ish time frame where you're not wanting to be super aggressive and you've still got like a decent sort of cash bond allocation there as well. So it's going to be less volatile if the market was to fall later in that process or later in that time frame. But I would probably prefer it to be more controllable, where I had, maybe this is just the way I think about things, but I would rather take all risk or no risk. So I think about it in those buckets where I would like to have, this is my risky bucket where I have like high growth, and I'm investing there aggressively. And then over here, I have my no risk bucket. So it's just like cash, savings account or whatever. So I would approach it like that and go for like a 2-stage scenario where the first period I would go aggressive, and then the next period I would go pile up some cash that way. I'm not sure if you see it, do you see it differently?
I think everything you said makes sense. I think a couple of things would be, and we've talked about it on another episode, is, if you're saying 5 to 8 years, this person clearly is not working to a date. They're working to a general time frame. And like, sure, if you need to buy a property on, March 20th of 2033, then it becomes a lot more stressful than if you're just trying to buy property somewhere in 5 to 10 years.
Somewhere around that time frame.
Because in that case, you can just wait, because it's not just the growth, right? It's also things like market conditions. Like if you get everything you want out of these ETFs in 5 to 8 years, but you're looking at buying, and we've just had like 3 straight years of 15% per annum property price growth. Interest rates are going down. Everyone's talking about a crash. I probably would still wait anyway. I'd be like, this feels like a hot market.
Okay. Yeah.
Like I might just sit on this for a year or two. Now I'm talking about obvious stuff, right? Like really obvious stuff.
But see, it might be obvious to you, but 95% of people are going to get FOMO and be like, I have to buy now because look how much it's gone up, and they'll just expect it to keep going up.
But we've said this on an episode before. I've been investing for 7-8 years. The only time I've immediately like just known without a doubt that this is a dip was COVID.
Yeah.
It was just obvious.
That was crazy.
And if it doesn't feel obvious, then you just say you don't know.
Okay.
But my point is, maybe there'll be a time like COVID, or during like, when the property prices were going crazy in 2021, it was pretty obvious that can't go on forever, and that like something's got to crack at some point. But not to get too much into timing the market and stuff. But point is, if you're flexible, then that's most of your wiggle room. The other thing is, if you do invest in a really aggressive portfolio like VDHG and IVV, nothing stops you from de-risking that over time. I think that's like an important thing. Like you get into year 6, like let's say you set yourself a benchmark, and the benchmark might be 6%. 6 or 7%. And then like after 5 years, it's actually gone up on average 9% per year. Just sell a bit out, because then you've locked in those gains, and then now like you sell out half of it and you put it in a savings account. Now the other half you've got in there only needs to go up 4% or something like that to actually like make out your original goal, but your exposure is like less. So I think some people can get really tripped up when they picture this stuff, because they think, oh my God, it's like a term deposit with ETFs. Like I put it in and then I get it out after 8 years. And it's like, you can adapt, you can change it, you can take the wins, you can, do all kinds of things along the way. Again, you don't need to fiddle with your portfolio all the time or like over poke it. But yeah, it was like something like when you have NDQ, and NDQ sometime last year or the year before, I looked at my portfolio, I have a small portion of it, and it was up like 40% in the year. And I was like, it's not going to go up 40% every year.
No.
Take the win and just be like, oh, that was more aggressive than I wanted, and I might need that money soon, so I'm just going to lock it in there. Who cares if it goes up again? it went up 40% in a year. Good on you, you know?
Yeah, it's tricky, isn't it? Because it's not that, I mean, naturally when we're thinking of those kind of time frames, we're just thinking about I put this money in every month and then I reach my goal or my target in 5, 6, 7, 8 years, and then I pull the money out. But like you said, there's a whole lot of ways that we can adapt the approach over time as the situation changes. Maybe stocks do better than property, so you reach your goal much sooner, or maybe the opposite happens where stocks do worse than property. Property booms and stocks do poorly, so you're going to need to be saving for longer, whether you like it or not, right? Or you decide to wait because it's been a super hot market and you realize, okay, this can't last forever, basically. So that's definitely worth considering. And it's not the case that, because people think, well, you've got an 8-year time frame. That's ages. But remember, not all of your money is going to be invested for 8 years. Only the first portion of your money is going to be invested for 8 years. Some of your money is only going to be invested for 2 years. So investing in the stock market with a 2-year time frame doesn't actually make that much sense. So you're going to have a pliable and adaptable approach anyway. You can't just, well, you could, but it's probably not advisable that you invest every single month for 8 years and then pull it out.
I completely agree. Yeah, I think 100%. You got to look at the nuance of it. You can't treat it like a really big black and white thing.
The only other thing I would add to that is you are dealing with a good time frame, but it's not indefinite, right? Because you have a finite time frame that you're dealing with, you do need to approach it with some sort of conservatism, because you don't want to get in a scenario where you've tried to juice returns too much and then it throws out your property buying goals significantly. So, imagine because home ownership itself is an emotional purchase in many ways. And so you can imagine the frustration of missing out on, the property you wanted at the time frame you wanted because you were trying to juice returns too much. You were kind of getting a little bit greedy, perhaps, in terms of if I just keep it in the market for another 2 years.
held another year.
Yes. Yeah. If I keep it in the market for another 2 years, then I can have a bigger deposit and then my mortgage won't be as much. So you can start to convince yourself that it makes more sense to hold longer or to keep investing for longer.
I saw this post the other day really quickly. Someone said it's a no-brainer to invest in Bitcoin. They said, if I put $67,000 in Bitcoin now, the best case is that it turns into $5 million in 5 years. And the worst case is it'll only go up to 100K. And that's not too bad. It's like,
so what's the downside?
Yeah, people can play weird games with their brains with this stuff.
That's the worst case scenario. Worst case scenario is I make a 50% return. Best case is like 50x. Yeah.
So that's probably all we have time for again today, Dave. That was really interesting questions. So thank you to our listeners. There was 4 wonderful listeners and 4 wonderful questions. We're going to do a really quick summary of those. So this question about, should I sell shares to invest in solar or battery setup? Super personal, different circumstances. We talked about costs of solar and batteries, changing landscapes of things, whether you're home or not, the cost of your electricity, all of these things play a really big impact on it. Really good thing for ChatGPT. Again, I can say that because I wouldn't consider talking about solar or battery economics to be, super complicated financial advice, but really great questions you can just ask and be like, describe your life and situation. Another great thing with ChatGPT is after you tell it stuff, ask it, can you please ask at least 5 questions that you need to understand me better? And then it'll ask you questions that you can then answer that'll help make sure they then giving you an even better answer. We also talked about the first home buyer deposit scheme, and we talked about, yes, the LMI kind of exemption or skipping that the government provides for new homeowners is a thing that can shift you in the right direction, but people don't need to go out and make big brash decisions about it. We also talked about a couple of Vanguard ETFs like VHY and VAP. These 2 ETFs follow the general trend of, there's some fringe ETFs. Generally, they're probably not that interesting to most people, but you can definitely check them out if you want to. And the last question we had was, is 5 to 8 years long enough time frame for a growth investment? And we basically talked about, generally it can be. It's good to take risks if you're comfortable with it, but importantly, you can invest in that over time. Over time, you can change your investments. The markets change, things change. Generally, 5 to 8 years is not an amount of time people need to over worry about stuff when it comes to investing. It's more if it's like 1 to 3 years you're trying to save for a home deposit that you need to start being really careful with this stuff. If you've been inspired by our listener's question and you'd like to ask your own question, you can actually follow a link in our show notes or description and share a question with us, and we can cover it on the podcast episode. However, if you just have questions generally or want to reach out and say hi, you can reach out to us, hello@aussiefilepod.com. Or if you don't want to email us and you want to talk to us on social media, because that's the trendy thing to do, you can reach out to Dave at Strong Money Australia on social media, or you can reach out to myself at Perla. And otherwise, thanks for listening. We hope this was interesting, and we'll catch you in the next episode.
Thanks for tuning in, guys.
We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to perla.com to browse our resources, calculators, and community insights. Perla is an authorized representative number 1281540 of Sandland Private Wealth Pty Ltd with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk and past performance is not a reliable indicator of future investment returns.